President Trump easing up on China a bit today and hardening his stance against the Fed, saying our problem is not China. Our problem is a Federal Reserve that is too proud to admit their mistake of acting too fast and tightening too much, and that I was right. They must cut rates bigger and faster and stop their ridiculous quantitative tightening now. Joining me now is former investment banker Carol Roth and our very own Jennifer Schonberger. Carol, you know, President Trump, obviously we know his disdain for the Federal Reserve, and I got to tell you, in the last few months, more and more people have joined him in thinking that the Fed has made some serious mistakes, particularly those rate cuts last year. What are your thoughts?
No, I absolutely hate this obsession with monetary policy and the Fed. I think it's completely misplaced. I think that it's weird, and I think it's obsessive. If you think about the role of the Fed and monetary policy and what they're trying to do, there is no legitimate demand for investment, whether it's on the consumer side or the business side, that is being held up because these businesses or consumers don't think interest rates are low enough. We've had low interest rates, historically low interest rates for years. We still have them. Why businesses aren't making the level of investment is because of uncertainty. They don't know what's going on with trade policy, whether it's with China or maybe perhaps our other allies. Political uncertainty. They're worried that a tweet could upset the market. So at this point, I think we need to stop with the bullying of the Fed, whether it's from the markets or from the president, because legitimately it's not impacting the demand for investment.
Jennifer, December 2015, the Fed hiked rates for the first time in almost a decade, and that January, the first 2 weeks of January, were the worst 2 weeks of January in the history of the market. So the Fed has been bullied by the markets for a very long time, and of course President Trump making his unhappiness well known as well. But again, what they do and what they say does move markets.
Of course, it definitely matters for the markets, Charles. And somebody told the president that the Fed did end quantitative tightening on August 1st. I think what's ironic here, though, is that the bond market is already doing the Fed's work for it. I mean, you look at the yield on the 10-year Treasury today, we're trading at, 1.6% and change. That's down from 2% just last week, right before the Fed cut. And so that is going to ripple through to mortgage rates, lower rates on credit cards, auto loans for businesses. But also, I would agree with the other guests in that that's only going to help on the margin. There's a lot of uncertainty here, and one of the reasons the Fed has been forced to cut is because they don't want a disaster in the markets. I think what's interesting, though, is that one of the reasons that the president wants the Fed to cut is because he wants the value of the dollar to drop so that we can compete better with other countries around the world. However, the Fed has touched off a global easing cycle here, and so once they cut, other central banks around the world are forced to lower their rates as well. And just look overnight, wow. The Bank of New Zealand cut, right. The Bank of Thailand cut. And so I think that tool of lowering rates to devalue the dollar may not be as potent as it used to be.
Carol, although we can't say that, the issue is other central banks are cutting, and they're cutting dramatically. And, there's got to be a relationship, a correlation between our rates and the global rates and the global economy, it would seem. And also, yep. The dollar does hurt the multinationals. That's why the Dow has been hit harder since China lowered its currency than any other index, because that's where you have a whole lot of multinationals.
Absolutely. I mean, it's a fair point, and I do think that we need better coordination amongst our allies. We need to be having more dialogue so that we're more coordinated. But as Jennifer mentioned, this is sort of a vicious cycle. We cut rates, so they feel like they have the cover to cut rates, and then they cut rates, and then we cut rates. And it's very dangerous. We're going to end up in a place where there's more risk assets and more bubbles. We're not going to have any arrows in our quiver around the world for when we actually do have a recession. So at some point, we need to get back to fundamentals, and we need to stop focusing on monetary policy.
Yeah, I think there's no more quivers and arrows. I think it's bazookas and quantitative easing from here on out. Ladies, thank you both very much. Carol,
thanks,
Jennifer,
Charles.
appreciate it.